Hello, County 522 students. This is Professor Lewis with your optional review day. So, hey, what I'm going to do is I'm going to talk just about the chapters briefly, kind of run through the slides. And my anticipation is that if you need additional help in what's there on the slides or some of the workout problems, that this will be just essentially another tool or another resource for you to use as you start your review. So I'm going to break this up into various sections so that you can go right to the chapter of most important for you. Now we're going to deal with chapter 3, tax planning strategies and limitations. Okay, so we learned there are 3 types of tax planning strategies: timing, conversion, and shifting. And although the tax folks will use names to describe these that are, some of these transactions that are really, uh, exotic or something like we're going to do this or that. In the end, all the transactions come down to 3 things: either timing, conversion, or shifting. So, what does that look like? Well, a timing transaction is simply one where you just play around with the time, the tax period in which you're going to report something. So, for instance, usually it's something to do with income or deductions. So the notion would be I'm a cash method taxpayer. I have the ability to bill people when I do services for them. And the question is, am I going to bill them so I get paid in 2000 and X7, say, or am I going to delay the bill so they can't pay me till 2000 X8? Because as a cash method taxpayer, I'm taxed on the year in which I receive the payment. Likewise, on acceleration of deductions, if I'm a cash method taxpayer, I have a bill, and the question is, do I pay that in December of one year, or do I wait till January of the next? So most of the timing strategies, really, the magic there is with the cash method taxpayer, although it's not exclusively. Sometimes it can be accrual as well within limitations, and the book has some additional examples you ought to be familiar with. Conversion is gets to the character question. As we've discussed in the junior core as well as in this class, we've talked about how within tax there's few buckets of income type, and they vary based upon the character, the way it's taxed. Capital gain or preferential gain or qualified dividend income or long-term capital gain, it's all sort of in the same bucket. You have ordinary, which is just the rates that just are exposed to the ordinary brackets. And then tax exempt, which has no taxable consequences at all. It's not taxable. It doesn't constitute what we call gross income. The thing about it is that on a conversion strategy, usually what we're trying to do is we're trying to convert our taxable income into, say, non-taxable income. So I have a corporate bond that's paying interest, and maybe I'm going to think about all else being equal with risk. Maybe I'm going to invest instead in a municipal bond, and that municipal bond will pay me interest. But unlike the corporate bond, which is taxable at ordinary rates, the muni bond may be tax exempt. A shifting transaction is the third type, and that is where we're going to sort of shift around between related tax parties. In order for this to work, you typically have to be dealing with different tax regimes. So you could have a corporation with a subsidiary, let's say, where somebody's operating in one state and not another. And you try to shift income from, say, the state of California to the state of Arizona, which has a lower income tax rate. Or likewise, like a family member, example I use in class is I could hire a child to work in my CPA practice, for instance, and pay them money, and they're in a lower income tax bracket, and for most of that situation, they wouldn't pay income tax at all because of the deductions, standard deduction. But essentially, I could shift money from my higher bracket to theirs for reasonable compensation. Or the other thing we talked about is if you have like a C corporation and they're trying to pay payments to their owners or shareholders, like for rent or a bonus or something. Any expense that's in a C corporation that comes out of the income actually goes out to the shareholders. That becomes subject to one level of tax rather than the money being retained inside the C corporation and paid out as a dividend, which would then be subject to 2 levels of tax. So there you have it. That's chapter 3 in a nutshell, the tax planning strategies, the 3 different types. Just be familiar with the types, the different transactions. And it's important because as you go throughout the rest of the chapters, it'll give you a chance to really appreciate when we talk about planning techniques in the case studies that we do in class or the general chapter problems. You can see these recurring themes as they move along. Okay, good luck, and we'll move on to the next chapter.